All right, well, here we go, everybody. Thanks for tuning in tonight. I appreciate everybody logging into this webinar. I am Rob Campbell with the Rob Campbell Mortgage Team, part of the Premier Mortgage Center brokerage network here in Ontario and out east. I wanted to have a very quick and concise presentation on what exactly is happening in the rate markets right now, because it seems to be making a lot of headlines and a lot of attention grabbing stuff out there in the media. And I wanted to make sure that we just basically skim the surface so that maybe you come away with this with a deeper understanding of where we are, where we came from, where we're about to go. And again, this is all for, just be careful. My big disclosure here is just to be careful, right? So nothing I say should be taken as or construed as investment or mortgage advice. This webinar is purely for educational purposes. So please consult with your mortgage broker, your banker, your financial planner, your accountant. Everyone's financial situation is different. So with that out of the way, don't sue me. Let's get cracking. So the agenda for this webinar is, number one, where rates are currently sitting at. Number two, where they may be heading. Number three, the differences between a variable rate and a fixed rate mortgage, what payment shock is and why you need to prepare for that, and some mortgage strategies moving forward that could save you or make you money. Okay, so I'm just going to dive right into it to make sure that we are mindful of everybody's time. Just make sure nobody else is waiting to get logged in here. Awesome. Okay. So where are rates today? So as of filming this right now, November the 15th, 2021, purchases under $1 million or a 25-year AM, these are considered insured purchases or insurable purchases. And just as a recap, an insured purchase is something that has to meet CMHC's guidelines and criteria. And that means it has to be on property under $1 million. It has to be a maximum of a 25-year amortization. And there's some certain guidelines that we have to absolutely maintain and stick with, being the GDS and the TDS ratios. So many of you watching this might already know what I'm talking about. Maybe you all kind of parted ways with it when you got the keys to the kingdom. But in a nutshell, we're talking about purchases under $1 million. Now, as a little bit of an asterisk, I wouldn't be surprised if CMHC or the government adjusts CMHC rules in the near future to incorporate properties up to maybe $1.25 million, because as we know, purchase prices are getting squeezed are getting driven up as far as what fair market value is or purchase price of just a simple detached home. So currently right now, a high ratio mortgage, meaning the cream of the crop fixed 5-year term, is in and around the 2.59% mark. Okay. And a variable rate mortgage is in and around that prime minus 1.1, which is roughly 1.35% at the time of recording this. If you look below that, a refinance or a purchase property over 30-year, up to 30-year amortization, I'm sorry. And the reason I'm lumping those in together is because, again, a refinance is not something that's insured by CMHC, and also a 30-year amortization on a purchase is not insured by CMHC. So this is stuff that's up to like 80% loan to value, nothing higher. You're looking at fixed rates in and around the 2.85% mark, and the variable rate is just a little bit less of a discount than what we had just discussed previously at around prime minus 1. So that's currently sitting at 1.45%. So going to the snapshot of rates just 2 months ago on September the 15th. Again, this is not a running average of all the lenders out there. This is just a quick little snapshot of what I found in my email from September the 15th, just as rates started to climb up. A purchase, respectively, in the same category as the other there, purchase under $1 million with a 25-year AM just 2 months ago was seeing a rate of 1.89%. A 70 basis points difference, roughly. Okay, so that's almost 1% difference, almost. And the variable, same, prime minus 1.1. Okay, a refinance rate 2 months ago, or a purchase with a 30-year RAM, up to a 30-year RAM, again, something that's not CMHC insured, again, 2.09%, about 75 basis points, about 70 basis points to 75 basis points difference. So again, huge spread there, huge difference in rates in just 2 months. Huge, I say huge because really we've been coasting in a low rate environment for so long, especially during COVID, but in just 2 months, they have jumped up drastically. So this is a bit of a precursor of maybe what is to come. And again, I can't guarantee where rates are going to go because there is so many layers of what's going to drive that. But if we go to where they might go, we take a look at how fixed rates are priced and what they're based off of. And they're based off of the 5-year bond yield. Okay, so the 5-year bond yield with the Bank of Canada is, as you can see in this graph below, a steady incline from the beginning of September. So this kind of ties into why there would be an increase in rates. Sorry, I'm just going off to the side to shut something down. Why there would be such a dramatic increase in fixed rate mortgages over the last 2 months. So if using this slide here, if we take the right-hand side of that chart at the very top at about 1.5% of that 5-year bond yield, and I minus the lower part on the left-hand side with the 0.8, we get that 0.7% difference. So that 0.7% that rates have increased on that bond yield, that yield has increased. We have seen a reflective increase in fixed mortgage rates. This is how fixed mortgage rates are priced. They're priced off of this 5-year bond yield. Okay, so as you can see from the beginning of September, they've steadily gone up to that 1.5%. So how these things are priced is a roughly a 1.25% increase on top of this yield to give you what the 5-year mortgage rate would be. This is a very loosey-goosey term and way of figuring out what the 5-year rate is. But in a nutshell, that's what it usually equates to be. About a 1 to a 1.25% increase over top of the bond yield is what the fixed mortgage rates are at, because that's how mortgage lenders sell off these mortgages as guaranteed bonds, and they can then make that spread, that 1.25% spread over top of the yield. Okay, so fixed rates and that five-year bond yield going back to the beginning of this year. So not just 2 or 3 months, but the beginning of the year. This is what the chart looks like for the fixed rate since the beginning, for the 5-year bond yield since the beginning of the year. Now, if we overlay the Toronto Stock Exchange chart on here, I'm trying to drive some comparison about how the stock market and bonds in this market have seemingly moved together. This is not to scale. This is not super accurate, but the red is the TSX chart, and that is basically at the beginning of 2021 to where we are right now. You can see the dips and the increases kind of fall in line with where the bond yield also goes following the market up. Now, if we stretch it out back over 10 years, this is what that 5-year bond, again, we're only talking about fixed rates right now. This is what the 5-year bond yield looks like over the last 10 years. And you can see how it ebbs and flows. And you can particularly see it where it is going from, the market corrections, whereas we see the beginnings of COVID and 2019 into 2020, and then a recovery in 2021. And if we overlay the TSX, now typically bonds and the stock market generally run in reverse of each other. So we can see a little bit of correlation between the 5-year bond and the TSX here. Again, not super accurate, just an overlay of how these things can move together and how the bond yield in this graph shows that it is kind of tracking with the TSX as well. it's all moving in one way over the last year to 2 years, as we can kind of see here. It's tracking up. And the reason it's tracking up, before I get into variable rates, the reason it's tracking up is purely because of inflation. The reason that the bond yields continue to increase is because the average investor out there looking to put their money into a bond, with inflation and the lessening the purchase power of that dollar over the 5 years that you have your money tied up in this bond, you could come out of the bond at the end of the 5 years with less money than you went into it, because of inflation, because inflation's chipping away at your Canadian dollar. So this is why these yields are continuing to increase. It is because of inflation, because investors want to know that when they get their money out at the end of that 5 years, again, we're not talking about mortgages anymore. We're talking about the bonds, which are tied to the mortgage rates. At the end of the 5 years, they want to ensure that they've gotten a good return on their money as it's been on the shelf for 5 years. If the bond yield doesn't increase to give them that cash flow that they're looking on the tail end, then they've actually lost money. If we're looking at like a net versus inflation. So now that I've rambled on about fixed markets and why they've gone up over the last little while, let's talk about variable rates, because it's very different in the variable rate world. A variable rate mortgage is based off of the overnight lending rate. I'm going to link up in the video here somewhere the video that I did on the overnight lending rate. It's out of date, but it'll give you an idea of how the overnight lending rate works with the Bank of Canada. So these are the headlines that you'd be hearing about. These are the headlines that you're going to be hearing about: Bank of Canada increasing rates. Analysts are saying rates are going to increase 4 to 8 times over the next, 2 years. These are the rates that they're talking about. They're talking about the variable rate mortgages, which is tied to the Bank of Canada's overnight lending rate. So I will link up the overnight lending rate video somewhere here shortly. And these variable rates that you can see in the graph here, the orange line would be the prime lending rate of lenders, and the blue line below it is the overnight lending rate. And you can see how these track identically as they move. And the reason is the overnight lending rate that the Bank of Canada sets is literally an overnight rate that banks borrow money from each other and the Bank of Canada. And as that overnight lending rate gets increased to slow down inflation, which, by the way, should have already happened already, but it is not. And the Bank of Canada seems to be asleep at the wheel on this for the past year, because they've been saying that inflation that we see is transitory. Okay. As they increase that overnight lending rate, it's supposed to slow down the market and bring inflation back in line. So this is why these two lines are a bit of a gap apart, is because lenders will have a prime lending rate, which is over and above that overnight lending rate. And that's how they base their prime when they're lending on variable rate mortgages and home equity lines of credit. If we look at this over the last, hella long time, you can see a comparison of, pre-2000, maybe pre-1995, those overnight lending rate and prime rates kind of touched each other every now and then. A little more room for swaying here and there previous to 1995-ish. But then as we get into the later years of the 2000s, you can see a very clear and distinct gap in between the overnight lending rate and lenders' prime rates. So back to the variable rates before I go into my next slide. Where are variable rates? So back to fixed rates quickly. Where are fixed rates going to go? We don't know. I'm going to assume fixed rates are going to continue to go up, but don't take my word for it. Nobody saw a pandemic coming. Nobody saw a huge drop in rates coming. We just didn't see it. So my guess is that fixed rates are going to continue to increase as inflation continues to be a problem in the next year. But who's to say that when the Bank of Canada increases the overnight lending rate and tries to cool down the market and bring inflation back in line, maybe we'll see those fixed rates come back down again. Don't know. So back to variable rates. Variable rates are dependent on the Bank of Canada's overnight lending rate. Let's say that you should probably, if you have a variable rate mortgage, you should probably bank on the Bank of Canada increasing that overnight lending rate next year at least 2 times. At least 2 times. Each move would be 1/4 of a point. So you're looking at least a 0.5 percentage point increase to the mortgage rates that are tied to variable and home equity line of credit mortgages. Okay, not fixed rate mortgages, variable rate mortgage and home equity line of credit mortgages. So bank on those rates going up next year at least 2 times, potentially 4 times, and maybe even more in the years to follow to cool down inflation. If I was a betting man, I would say at least 2 times, probably not 4 times, but who am I to say? So what is the difference between a variable and a fixed rate? Well, I just covered it. Fixed rates are based off of bond yields and variable rates are based off of the overnight lending rates and thus the prime lending rate of Canada. There is a big difference. Can they move together, ebbs and flows their way up and down? Yeah, they can. They absolutely can. But there is generally always a gap in between the fixed and the variable rate mortgage, which at this point is north of 1% difference. The variable rate is at least, really like at least 1.25% lower than the fixed rate, depending on product, maybe a 1.5%, 1.5% lower than the fixed rates. But there is a big difference. So what is payment shock? One of the things I wanted to talk to everybody tonight about was payment shock and how that can affect your mortgage payments moving forward. Should you find yourself in a low interest rate environment right now, but not better prepare for rates going up as they have done in the last 2 months and as they might continue to do over the next year or two, especially if you're coming up for maturity with your mortgage. So payment shock occurs when rather suddenly someone is obligated to pay more in monthly debt than they can afford from their income or that they were anticipating to pay. Shock is the key word there, right? One day you wake up and all of a sudden the price of something has drastically increased and you weren't prepared for that. You didn't get ready for it. And that's what I want to explain to you right now, so that maybe in the future you'll be better prepared when rates go up and when you have a mortgage maturing. So I'm going to use an example here. I'm going to use an example of Jane. So Jane buys a house for $650,000 with a $40,000 down payment, which by the way is a minimum down payment on a $650,000 mortgage. Down payments are tiered once you get past $500,000. So $650,000 purchase, $40,000 down at 1.89% over a 25-year amortization. Her payment is $2,652 monthly. And at the end of the 5-year term, her mortgage balance is now $530,200. So to back up the bus, as I said in one of our first slides there, interest rates 2 months ago for a minimum down payment home were 1.89%. Here in Southwestern Ontario, depending on the town, I'm going to take a drink quickly, sorry. Depending on the town or the city that you're buying in, $650,000 might buy you a stacked townhome. It might buy you a very small starter detached home in Guelph. It might buy you a mansion in Cochrane, Ontario. I mean, I don't know. But for all intents and purposes, let's say it's a detached home for $650,000, minimum down payment of $40,000 plus closing costs, blah, blah, blah. 1.89% over 25 years. The monthly payment for Jane is $2,652 per month. Okay. At the end of 5 years. So she got this rate in like 2 months ago, closed, got the keys, moved in. Jane's moved in. She's making her mortgage payments. In 5 years from now, if she doesn't make any prepayments on her mortgage balance will be $530,200. If she's just paying monthly, no top ups to payments, just paying it as per the contract. Okay. So the next question is, when Jane renews her mortgage at a higher rate of 3.25% with 20 years remaining, how much is her new payment? Again, when she renews in 5 years, and let's assume rates have gone up to 3.25% at that time. Again, huge disclaimer, I have no idea where it's going to be. I'm just painting a picture. They might be at 3.5% or 4%. They might be at 5%. They might be back down to 1.89%. We don't know, but I'm just trying to paint a picture. If Jane renews her mortgage at maturity and takes a 3.25% mortgage with 20 years remaining, right? If she stays with the lender or transfers to another lender with the 20 years remaining, how much is her new payment? Anybody want to take a guess? If you were really quick with your eyeballs, you would have seen that I messed up my slides and I would have shown you already. Her new payment at maturity with less years remaining and a slightly, well, not a slightly higher, like a 3.25% mortgage, that's quite a ways higher. Her new monthly payment would be $3,000 per month. Okay. That, ladies and gentlemen, is payment shock. That is an increase per month, even though the mortgage balance has gone down. That is an increase to a mortgage payment of $350 per month. Why do I bring this up? Because a lot of you have just locked in a 5-year fixed mortgage at 2.09, 2.19, 2.29, 1.99, 1.89, whatever that is. And it's a set it and forget it mentality. But if you don't prepare for what the market's doing and you don't keep on top of that, or you don't message your buddy Rob and ask about these things beforehand, you're going to realize a little bit of payment shock because these rates might never be seen again this low. These rates that we just experienced were the lowest in Canadian history. So this is what payment shock is. You come up for maturity. Our minds say, well, I'm 5 years in. I only have 20 years remaining. I should be good to go. Not the case. Not the case. So hang on here. Next slide. So I wanted to share some mortgage strategies to save or make you some money, going back to the previous slide, to help avoid payment shock, first and foremost, as rates start to increase, but also just thinking outside of the box, because we all, it's easy for me to say this because I'm involved in mortgages every single day. But I'm definitely like this when it comes to other stuff in my life, like life insurance policies and car insurance and house insurance. Like, I don't know. That's why I call the people that I rely on, like I hope that you reach out to me for. So here's some mortgage strategies to save or make you some money moving forward. I really, really, really think that we're moving into a time where we have to learn to be frugal. We have to learn to take care of our P's and Q's. We have to start thinking like our grandparents, our immigrant grandparents and great grandparents that may have come here with $0 in the bank. We got to start thinking about our debts, paying off our debts, making good on our debts so that we can prosper moving forward. So some of these strategies, none of this stuff is mind melding or news breaking, but I wanted to go over them anyway with you, just as a subtle reminder. So number one way that you can save yourself money is topping up your mortgage payments. Every mortgage lender out there, good or bad, has prepayment options. They are called prepayment options. You can call up your customer service at your lender and ask them what your prepayment options are. You'll be able to top up your monthly payment by 10% or 15% or 20% from your payment. So a really easy example, $1,000 monthly payment, you can top it up. If we're talking about 20% top up, if your monthly payment's $1,000, you can top it up $200. That extra $200 will only go towards principal repayment, no interest. As a matter of fact, it will save you interest in the long term of your mortgage because you're overstepping those payments by making that prepayment of principal reduction and thus foregoing the interest that would have been charged on those principal payments. So it's really important to top up your payments if you can. You don't have to go to the maximum that you can. Top it up to the nearest dollar, the nearest $10, the nearest $100, the nearest $200, whatever you're comfortable with, but really consider doing that. It is the easiest way to do it. They just set it up every month. You don't even notice because you just get used to paying it. Another option with a lot of lenders is double upping your payments. So if your mortgage payment's $1,000, you have the ability to double up that payment on a payment date. So January 1st rolls around and your mortgage payment comes out of $1,000. If you've set up a double up payment, another $1,000 would come out on the exact same payment date, but that extra $1,000 is a prepayment. Again, foregoing the interest that it would have charged you in the long run. And then bulk payments. So bulk payments are bulk payments towards your mortgage balance. And a lot of lenders out there have different ways of doing this, but in essence, if you come into money, whether it's a CRA tax refund or an inheritance or a bonus at work, you can definitely put those extra funds towards your principal balance. Remember, that's going to help you with stuff like payment shock or just paying your mortgage off early. Okay. Accelerated payments, another easy one. Accelerated payments is simply having your biweekly or your weekly payments topped up to pay as if it was a 13-month year instead of a 12-month year. So you're actually forcing yourself to pay that extra month every year, and that extra month that you're paying goes towards principal reduction, no interest. So it's a really good way of just chipping away at the principal balance without even thinking about it. Because a lot of people get caught up with the bulk payments, like, oh, I can't come up with 20,000 or 10,000. But a lot of you out there can top up your monthly payments, or even go into accelerated payments and chip away at an extra 20 or 30 bucks per installment. It can help. Another option is to refinance debt for a lower rate and extend your amortization out again. Now, I bring this up because some people don't know that you can actually refinance your mortgage. Rob, we bought our house 6 years ago. We renewed with our lender last year, but man, we've racked up some debt during COVID, and we had to buy a used car, and that's costing us 6% a month. And sorry, not 6% a month, 6% a year on a car loan. And we've got lines of credit that we've maxed out. We don't know what to do. I've had clients actually say that they were really considering selling their home. You don't have to sell your home. You can take advantage of the way that the market has been acting and take advantage of that equity that you have built up to not take on more debt, but shift the debt from a bad debt to a lesser evil debt, being the house, right? And remember, if you're paying out on a monthly basis, if you're paying out $800 in credit card and car loan debt, and if you refinance it in your mortgage and you can get a low rate with your mortgage and only end up paying $200 more a month, if you're used to paying the 800 plus the mortgage payment that you had, and now you're actually saving $600 a month, why not just do the bulk payments and set it up like that already to pay forward into your mortgage again, right? Because you can get ahead of the debt. You're just putting in one nice, neat payment on one low rate, and you're prepaying the mortgage to make sure that your interest costs over the lifetime of the mortgage are reduced. If you're just making the mortgage payment and there's not a lot of strategy to it, you could end up paying more, obviously, in the long term of having that debt in a mortgage. So there's good ways and bad ways of doing that. Also, refinancing CRA debt for the self-employed. This has been big over the last 2 years. People who have taken on debt because of COVID, their incomes have been deteriorated because they're self-employed and they weren't able to do the job that they were supposed to be doing out there in the world. And now they've amassed not only consumer debt, but maybe they're behind on their CRA taxes. Traditional banks will not refinance mortgages to incorporate a CRA debt repayment, but we have alternative lenders in the broker space that will do that as little as a 1-year term, so that you could just refi the debt into the CRA loan into the debt, get back on track, and then 1 year after, we take you back to a bank or a broker lender for AAA rates. So we can do that. Number 5 is a variable rate mortgage with top up to payments. Remember the slide previously about variable rate mortgages being really low. Yes, the rates are going to go up. But what if you were able to redo your mortgage today into a variable rate mortgage? Maybe you're coming out of a mortgage that's at 3.25% that you got 3 or 4 years ago, and you get down to a 1.5% interest rate. You take that 1.5% that you're saving in a monthly payment and top up or do bulk payments to the variable rate mortgage. So net every month, you're still out the same cash, but what you're doing is you're making a much bigger prepayment to your mortgage principal balance instead of it going to interest. So again, just becoming more aware of maybe becoming mortgage free sooner. Another strategy is a home equity line of credit for renovations. So I know we've got some realtors on the call who love helping clients sell their home and move to another home, and maybe move a step up when it comes to square footage in their home. But sometimes people cannot realize that because of income issues or credit issues. And in this market, let's be honest, if you're trying to stay within the same city, most people aren't moving because they can't afford to move because of the prices and where they sit today. So another option is getting a home equity line of credit for renovations on your home. We do these all the time for our clients, where we'll redo their mortgage, restructure it up, maybe get them a super low variable rate interest rate, and or a lower fixed rate than what they were used to, and then tack on a home equity line of credit beside that mortgage with the same lender for home renovations. To finish out a basement, maybe you're looking at $300 a square foot to complete. Maybe it's more, maybe it's less, depending on what you're doing to the basement. Maybe you're adding a bedroom. You got to think about egress windows, fire safety. Are you jackhammering the floor to put in a bathroom? Are you putting in a separate rental unit? That might be an option to increase your cash flow at home. There's some options for you that we can look at with a home equity line of credit for the renovations. The bonus of that versus just an equity takeout, like just a refinance to get the money out, is that you can use the home equity line of credit as you go along with the renovations. Whereas if you do an equity takeout, you're basically paying for that amount of money that's just sitting there while you're waiting for the renovations to be done. So home equity lines of credit are a really good option for a home renovation. Also, a home equity line of credit for down payment moving forward. So let's back up again. Some realtors on this call. You have clients that want to move, but they want to, all of their equities tied up in their home. And you know what? They want to actually keep the home that they're in as a rental and rent it out to keep it as an asset. Well, restructure your mortgage, tie on a home equity line of credit into your mortgage, and then you can draw from that home equity line of credit as your down payment moving forward. So we restructure the debt properly if you know it's going to turn into a rental property, or maybe you're buying a cottage or a second family property. Home equity lines of credit can draw the equity out of your owner occupied property to be able to take that next step. Again, home equity lines of credit are not for buying speedboats, face tattoos, trips to the casino. Not a good option. If you're using the debt for building equity and it's a very sound and structured plan, it can be a very, very effective way of accessing the equity that you could have in your home. And the last one here with big risk is the tax deductible mortgage strategy. Some of you know it as the Smith maneuver. That's a trademark term. Don't sue me, Robinson, if you're watching this, Robinson Smith. But a tax deductible mortgage strategy means you get a home equity line of credit on your property and you utilize that HELOC for investment purposes. And if it's done properly and done correctly and set up properly from the jump, with the help of an accountant, with the help of a mortgage broker, and with the help of an investment advisor, you could use the equity in your home to invest in equities in the market to be able to earn a return, and you can write off the interest on the home equity line of credit. Again, there is risk with this. Obviously, if markets go down and you've drawn out $200,000 to invest in the markets, poof goes the money, right? Boom goes the dynamite. That's it. I tried to keep it under a half an hour, but I don't think that I did. But I'm going to take any questions that you might have. If you have any questions, just flip them into the chat menu and I will watch for that. I'm going to stop sharing my screen now and see if we have any questions. I will just hang out here. I appreciate everybody being on the call. Again, if you have any questions, just go ahead and type them in the chat menu or the chat window there. And while I'm waiting on that, I just want to let everybody know that you can either comment below. I'm going to put this up afterwards. You can comment below with your questions. You can Google me and email me. If you're a past client of mine, you can certainly email me. And if any of the stuff that we've been talking about tonight kind of tweaks your interest and you want to book a call, we can certainly do that as well to answer your questions. Again, just to recap, where are rates going? Nobody has that crystal ball. Nobody really knows, right? Because it's market driven. All I do know is this: in 2 months, they've shot up quite drastically, and most of those movements were within a week or two span, and they don't seem to be slowing down. They seem to be still going up. So will be interesting times in the first quarter of 2022. There's a lot of things at play here. There's the Bank of Canada. Should they be increasing the overnight lending rate, which is tied to all sorts of debt repayment with the government because of quantitative easing. We've got we've got a pandemic that we're still trying to shake out. We've got a lot of stuff at play here. And if I was a betting man, I would say that the Bank of Canada definitely will move that interest rate next year, but it's up for debate on how much they are going to move it. My bet is they're going to move it at least 2 times, I'm not sure that they're going to move it more than 4 times next year. I think they would end up choking out the market. But again, this is purely educational purposes. You need to consult with professionals and then go on your own instinct. I'm going to sign off here, guys. Thank you so much for watching. There's no questions in the chat bar. I appreciate all of you that have watched this to the end. Take care of yourselves. Thank you so much for tuning in. And I will talk to you later. Rob Campbell out.